Okay, that is Wipro talking about their Q3 guidance. It factors in the changing market realities. So in a way, they are being a bit conscious of the fact that things perhaps could be slowing down. And even on hiring, the management did say that going ahead, they've already made a lot of investments. Their investments in hiring were front-loaded. But going ahead, they will be conscious of the external environment, of the demand, and then continue with their hiring process. On margins, we had Jatin Dalal, the CFO, saying the Q3 margins will be impacted by wage hikes, 2 months of it, and therefore we shouldn't expect a big improvement in Q3 margins. Quite tight-lipped about the medium-term outlook on margins. Let's move on then and talk about HCL Tech, because HCL Tech, on the other hand, has reported a very strong quarter. The stock also is higher in trade, currently up. It's the top Nifty gainer with a rally of close to about 3-odd%. So HCL Tech is the top gainer, while Wipro is the top Nifty loser. As I said, very divergent performance. On HCL Tech, Q2 revenue strong, in line with expectations. Margins have beaten expectations in the September quarter, expanded by 100 basis points, and margins are now at 18% versus street expectations of 17.4%. Deal wins too have risen on a quarter-on-quarter basis. They've gone up by 16%, and deal wins for HCL Tech have been very strong. Hiring numbers also, look good, unlike in the case of Wipro as well as TCS, where we've seen a moderation in hiring. For HCL Tech, the hiring numbers also strong. But what the street really liked is the confidence that the company has, the management commentary, because of which they've gone ahead and raised the full-year revenue guidance. They're now expecting revenue growth to be closer to 13.5% to 14.5% this year. And, for HCL Tech, there are two businesses. One is services business, which is akin to your Infy and TCS. And the other one is your products business. Now, in the services business, HCL Tech has said that they will be growing by 16 to 17%, which means it's perhaps going to be the fastest growing large cap IT company in the services business. And that is something that the street is saying. So considering its valuations are relatively cheaper at about 15.5, 16 times, and the company's growth rates are now looking superior with this upgraded guidance, the street, you can see some buying by investors. Margin guidance has been brought down, but that hasn't come in as a big surprise. Listen into what the management had to tell the press yesterday.
Margin performance has significantly improved.